Today, should we buy the dip? Hello again, it's Martin North from Digital Finance Analytics, working on this post covering finance and property news with a distinctively Australian flavour. Well, I've listened to a whole lot of rubbish over the last couple of days with people claiming that everything is going to collapse and it's all over. Well, I'm afraid that's too simplistic. You need to go into much more granular analysis to really understand what's going on. And indeed, the S&P 500 cut its losses to close positive on Thursday, led by dip buying action in tech stocks after Russia launched that full-scale invasion of Ukraine. The S&P 500 rose 1.5% to 4,288. The Dow Jones Industrial Average rose 0.28% to 33,223, and the Nasdaq rose 3.3% after falling into bear territory intraday with a 20% decline from a recent peak and landed at 13,473. Russia, of course, launched an invasion on Ukraine, triggering condemnation from world leaders and ratcheting up geopolitical tensions. The US responded with fresh sanctions on Russia, aimed at further crippling Moscow's ability to raise funds and to import key technology. But in the short term, that won't make much difference at all on the ground. But then, commodity prices were moving higher against the backdrop of a market already in correction territory and facing the prospect of rising rates. And it points to a bleak market outlook, according to Philip Towers, CEO and portfolio manager of Towers Asset Management. The weakness that followed in stocks, however, triggered dip buying with battered tech stocks in demand. Apple, Amazon, Meta Platform, and Alphabet and Microsoft were all higher. The rebound in big tech comes as some on Wall Street urged investors to act with caution and to focus on higher tech quality stocks with healthy level of cash flows. We view these geopolitical shock events as times not to panic, but instead selectively focus on the defensive tech stocks with significant free cash flow, Wedbush said in the note. And with the broader market in correction, some investors flagged higher paying dividend stocks in sectors including healthcare and communications services as potential areas of interest that can somewhat blunt the impact of a market crash. In falling markets, it's not about having the best gain, but having the least loss, Towers said. Higher dividend stocks provide a sort of natural rebound because as the price of the stock falls, a relatively reliable, stable dividend in places like healthcare and communication services, as well as other categories, are unlikely to be immediately affected by a downturn in financial markets and are able to recover quicker from losses. The volatility index, which of course measures the implied volatility of the S&P 500 options, was down 2.26% to 30.32. Gold futures for April delivery was up 0.28% to 1,910 after an earlier drop, and WTI crude oil for delivery in April rose 1.41% to 94.31. The euro-US dollar was unchanged at 1.11, while the US dollar index futures was up 0.9% to 97.05. Bitcoin's price recently soared by $2,500 US within an hour of US President Joe Biden's comments on Russia's invasion of Ukraine. So it recovered, in fact, to a price seen since before the market panic surrounding the conflict took place. Yesterday, Bitcoin's price collapsed from 39,000 US to 34,500 after Russian forces began attacking Ukraine's military infrastructure. In fact, over $400 million in liquidations took place following the crash. The entire crypto market declined by around $200 billion on the news, leaving it in total at just $1.6 trillion. Today, President Biden announced that Russia's aggression cannot go unanswered and promised sanctions on 4 of Russia's largest banks from the US and Western allies. He said they'd limit Russia's ability to do business in dollars, euros, pounds and yen to be part of the global economy. And the president also promised to send more forces to Germany to support the NATO alliance along the eastern flank. However, he also made it clear that no troops will be sent directly to Ukraine to take part in the conflict. Bitcoin responded immediately on the news, sitting at $36,300. As at 2 p.m. EST, it went up to 39,000 exactly 1 hour later. The latest is back to 38,343 as I record this. The president's comments were likely quite reassuring for Americans who held momentary fears of an incoming World War III scenario. An Associated Press poll found that just 26% of the population support playing a major role in the conflict. Bitcoin's price action in response to news of war may suggest that it's not a safe haven asset, as of course many had earlier claimed. More broadly then, so across the market, should we buy the dip then? Investors should probably hold back from putting cash to work in the sinking markets as geopolitical fears swirl around Russia's full-scale invasion of Ukraine, at least according to Paul Christopher, head of global market strategy at Wells Fargo's Investment Institute. Now is not a time to be buying the dip if you have cash, and don't sell, he said. It's just a time to be patient, as there's too much uncertainty. While investors have been anxious about geopolitical tensions surrounding Ukraine, a full-scale invasion of the country by Russia was not priced into the markets, according to Christopher. The stock market is on its heels ahead of anticipated rate hikes by the Federal Reserve, possibly as soon as next month, to tame high inflation that risks running hotter because of the invasion, he said. While some investors may also be worried about the potential for another Cold War, he said it's not clear Russia would have the economic resources to expand its imperial reach and subjugate countries in a buffer zone around its border, like in the days of the former Soviet Union. President Joe Biden on Thursday, while announcing new international sanctions against Russia, said it was still too early to tell if the conflict in Ukraine could be contained or if it would spill over into another Cold War. The more immediate worry for investors is what happens with inflation, said Christopher, pointing to potential disruptions to the balance of supply and demand in energy, aluminium, nickel, and fertilizer. That could push up prices. With inflation running at 7.5% year over year, that spillover is the main concern for investors. In Christopher's view, rate hikes by the Federal Reserve aren't off the table, despite the turmoil created by Russian President Vladimir Putin's decision to attack Ukraine on Thursday. While a more moderate Fed going forward seems likely, Christopher said that with the economy still growing, they could easily do a quarter point in March and then just say, we'll be data dependent. In the meantime, Christopher says he continues to favour US stocks over international equities, saying Russian-related tensions likely will weigh more heavily on European markets. The Stoxx 600 was 3.28% lower on Thursday, while the London FTSE dropped 3.88%. Despite its physical size, Russia has a relatively small economy, and its largest trading partners are China and Europe, according to a Wells Fargo investment research note that was authored by Christopher. There is little direct trade between Russia and the world outside of Europe and China, so both the sanctions on Russia and damage to sentiment likely will fall squarely on the European economies. And within equities, Christopher says he continues to like quality bets in areas including information technology and communication services, as well as cyclicals such as financials and industrials. And he said that he recommends underweighting defensive sectors, including utilities and consumer staples. We're not looking for a recession in 2022, Christopher said. We think you'll have a chance to buy equities later this year. Well, I have to say I tend to align with his view, as I think there will be more volatility ahead first and more uncertainty. If the European situation continues to deteriorate, Central banks may not lift rates so aggressively, but if things calm down, then they will, because the inflation genie is out of the bottle. And by the way, further rises in oil prices will drive inflation even higher. So central banks will have to act, and when they do, markets will go lower. So this is indeed a time for patience and not trying to make a quick trading buck. In fact, I think just at the moment, cash is certainly not trash. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.